Here we go.
Are we in, Dinny?
He's back. He's back on Facebook. It's been years since he's been on the stream, the platform. Mark Zuckerberg will be delighted that you're back.
Yeah, Dinny's after making me get Facebook going again after years of exile. So,
see, Jack's a kid, right? So Facebook is obsolete to the younger generation. There's only us old fogies who still use this thing. So, thanks for jumping on, Jack. I know you've only got a couple of minutes and you're busy there, but what do you think of recent events over the last week? Just thought I'd try and get your take on it.
yeah, no bother. Yeah, are you putting this on YouTube after, or is this just a strictly Facebook only thing?
I'll put it everywhere, man.
I'm gonna be clipped all over the internet now. It's better watch what I say.
Yeah. You might even be on RT News if you're lucky.
So have you been following the whole FTX thing, Dinny? Have you been covering it, or have you just been high level, get your keys off everywhere? Like,
no, I've definitely been following it, and every day there's just more and more stuff coming out, and it's I don't know, is the guy crazy or just a fall guy, or what the hell is going on? But it is a fucking mess. What do you reckon?
yeah. Look, I don't know, but as you said, more and more things are coming out every day, and it's just getting like there's some stuff I don't even think suitable to say on Facebook. You know, all kinds of mad stuff, these kind of sex parties and all this kind of thing starting to come out of it. But it's it's totally crazy. And look, looks like there could be some kind of links to political fundraising, all that kind of stuff, and maybe even some level the whole thing was there's just so much, I don't even know where you start. So where do you want me starting it?
What sort of damage do you think it's going to do for our industry?
Well, look, put it this way. So Alameda, so there's two main companies in this. There's FTX, which a lot of people had heard of. Now, to be honest, FTX wasn't massive in Ireland. Like it was big in the US and big in a lot of other countries, but not too big in Ireland. By far, Coinbase is the biggest in Ireland. So a lot of Irish people weren't even aware of FTX. So that's one half of it, and the other half is then Alameda. So Alameda was FTX's investing arm, which was actually probably even bigger than FTX. So FTX was the second or third biggest, depending on who you ask, exchange in the world, behind either, Coinbase and ahead of Binance, or, mix around a bit. But so you had FTX, second biggest exchange in the world, Alameda, in the top 3 or 4 biggest kind of asset managers, hedge funds, market makers that manage a lot of the very, very rich people's money in the space. Now, FTX's whole business model was they got so big because they didn't really charge fees. Like they only charged a couple of basis points. So if you buy Bitcoin on Coinbase, you'll see that their fees, I don't know, they change it quite a bit, but it's usually like 0.5% or 1%. So that's 0.5% is 50 basis points. The fees in FTX were 3 basis points. And he came up with a whole spiel of how they're managing to do this with very efficient systems and all that. But in reality, they could only do this because they were stealing your money and giving it to Alameda. So it's like you can literally listen to him on podcasts talk over the past 2 years saying that they've reinvented the industry. They only have like a couple hundred employees compared to a couple thousand. And because they're so efficient, they don't have to charge high fees. But like they were literally charging less than 10% of what their main competitors were charging. So anyway, the reason how this was the case is, so you have the sister company, the digital asset fund, and you have FTX. So FTX were basically so they had billions and billions of dollars on the platform in all kinds of crypto, lots of Bitcoin, all kinds of crypto, US dollars, whatever, had it on the platform. They were taking the user assets and then giving it to the sister company to invest. Now, look, there's a few, it's still not clear. There's a lot of different kind of angles you could go with this, go into specifics. It's still a gray area, but like it's kind of clear as day Now they're trying to say they didn't realize they were doing this or something, which just sounds totally unbelievable. Like they obviously knew what they were doing, but it's a bit unclear as to the specifics of the whole thing. But the general gist is this was almost certainly happening. They were taking all user assets on the exchange. So just outright fraud. It's like when you hear people talking about calling for more regulation in the crypto space or whatever, like this is just fraud. Like regulation isn't going to stop this. It's totally fraud, totally criminal behavior. Like in their terms of service, they didn't have anywhere where when you gave your money to FTX, it said that the title still remained yours and your money was your money sitting on FTX. So they were regulated in many different parts of the world, very well established in the US, and they just broke those terms of service and just lent all the user assets for the most part to their sister company, Alameda, to make investments on cryptos and businesses they liked. So Alameda, through the sister company of FTX, the big hedge fund, digital asset hedge fund, had its hands, because you can imagine how much money they had, billions and billions and billions of user assets going to Alameda, and then they were making investments into every kind of company in the space because they had so much money to throw out, and they basically had it worked out that they didn't think anyone would ever come back for the money because they're so big and they're getting bigger that they were just going to get away with it. Now, so look, it wasn't just investments they were making. It wasn't just direct, say, making investments in businesses. They held tokens and assets and all kinds of things, and it was all very dodgy. Like there's stuff like, and this has been going on in the crypto industry a long time, but there was stuff going on where they'd make an investment in a company, and the company issues a token, and then that token is pumped on FTX, and Alameda also buying the token early and sell out. So just massive outright pump and dump schemes. Now, someone leaked. So, okay, first of all, someone leaked the Alameda balance sheet to show all their holdings and their assets, and everyone was like, where the hell did all this come from? Like, so later on, it was able to be deduced back that it just all came from FTX user assets, but that wasn't clear immediately. So what was clear immediately, that FTX, so the user assets that was lent to Alameda that wasn't known about at the time, the vast majority of Alameda's balance sheet was in FTX's own token, FTT. So FTX issued their own token. Alameda bought a load of this token with user assets to pump up the price. And then what Alameda did was they borrowed off the strength of their own token. So I don't know who even gave them a loan. This isn't clear yet who even gave this loan, but they used their token as collateral to borrow 5 or 10 billion, no, don't even know how much, but billions and billions of dollars. So they use their own token as collateral, which they'd use user assets to pump up the price of, to get a line of credit to basically make even more investments and stuff in the space. And when this was leaked out, your man from Binance, CZ, he got wind of this. Now, Binance are a big competitor to FTX, but they did hold a couple $100 million worth of their token. Your man basically immediately sold all the tokens, which crashed the price. FTX stepped in then to try and backstop it. They were saying all this kind of stuff like, we're highly liquid, we're safe, all this, we're going to support the price of the token. And then more and more people started digging, and that's when it started to become clear that they were just using user assets on FTX to try and stop the price of their token collapsing. And then the token collapsed and none of the user assets were reclaimable in FTX. So if your balance on FTX was showing you had 1 Bitcoin or you had half a Bitcoin, none of that was really there because it was all given to Alameda to make investments, and most of that was given to just buy the FTX token itself, pump the token. When CZ got wind of it in Binance, he pulled all their support for the token. Everyone then started shorting it. All the information started to come out. People started looking, and then the whole thing just plummeted. So what happened was the end game of it was that you had the second biggest exchange in the world you lose all user assets. So millions of customers just lost all their assets
It
overnight.
vaporized. It vaporized in a couple of days.
Yeah, yeah.
Crazy.
So and Binance, like this was a great business move for Binance, because Binance were, you know, exactly their main competitor. Like Binance are a little bit different to Coinbase. Coinbase kind of take a little bit a different angle. But Binance and FTX, their whole thing is kind of like derivatives offshore, like all big margin trading, like and this gets into the next part of the problem then, all the big trading desks in crypto, all the big hedge funds, when you buy on a lot of exchanges, so when you're buying on a lot of the smaller exchanges, you're not actually buying on those exchanges per se. Those exchanges are like a front end to buy through FTX. So they would have had a lot of assets on FTX in order to facilitate the exchange, facilitate their exchange platform. So FTX was basically powering tons of other businesses. And when all the assets went, it meant that if a smaller exchange, like a business operating the space, had assets on FTX in order to facilitate their trades, those assets are now gone as well. So then those exchanges go bust. But it actually gets even worse than that, because Alameda was seen to be, because they were so big, they were seen to be too big to fail. So kind of like your Lehman Brothers, whatever, in 2008. Because they were seen to be too big to fail, a lot of crypto lending, crypto finance, investment firms were lending, and even exchanges, and this is how other exchanges are getting in trouble as well, they were lending a proportion of their user assets to Alameda unsecured. So if they had, and think of like savings products in the space, savings products where you go to some exchange and you're getting like 7 or 8% yield on your assets. So stuff like Celsius, like before that went, but there's still things operating like that. How they were generating a lot of that yield was they were just lending straight out to counterparties like Alameda. And Alameda were saying to them, whatever you lend us for the next year, we'll pay you, 8% or whatever. So, and then it depends. So if the user is getting like 8% on their crypto savings interest platform, Alameda are paying that platform like 9%, and the savings platform keeps 1% for themselves, gives 8% back to the users. Now, the big problem is Alameda were too big to fail. All that money was lent unsecured because they were deemed too big to fail, and now that money's gone. So that's why you hear what you call a contagion event of all other exchanges, platforms, crypto lenders. They're all starting to shut off withdrawals because none of them have the money. And there's some of them now, they're trying to wing it. Like there's a good few ones that are kind of doing these things where they're trying to stop you withdrawing. They're saying things like, we need to update your KYC proof of address before we can let you withdraw for your own protection, all that. That's just a total smokescreen, because it means they don't have your money. So if that's the case, get your money out of it ASAP, because if you push them hard enough and you do the tasks, they will have money to give out, but they don't have everyone's money to give out. So, run on the bank, first come, first served. So again, it kind of comes down to like the traditional finance system doesn't really operate that much different to what goes on here, except in traditional finance, you have the government to step in and stop when these things go poof. And in cryptocurrency globally, like there is regulation there in most jurisdictions where this is just outright totally illegal. So the reason I'm saying this is you're going to start to hear a narrative now where we need to regulate crypto and Bitcoin more. But like this wasn't really anything to do with regulation. This was all to do with just outright fraud. So like fraud happens all the time in traditional finance. So yeah, look, I suppose I know I maybe deviate a bit from your initial question, but the effect this is having on the industry is like all the big players were lending unsecured, like literally every single one of them, to Alameda. They were one of the biggest. Alameda and FTX are now gone. They've lost all the assets. It's just a question of how much each platform was lending to them and can they recover from it. So not everyone will go under. And to be honest, I think a lot of the bigger ones, like I don't think like Coinbase and stuff, because they're publicly audited. They're a public company. They have to release all their statements. Now, who knows? But some of those kind of ones probably aren't as affected. Coinbase did lose money. I think they said they lost 20 or 30 million, which sounds like a lot, but Coinbase, like, it's not too bad. But like a lot of the medium-sized, smaller ones, and the ones that were taking insane risk, so ones that were paying insanely high yields. So like you even see it with Gemini. Gemini had their earn product. They now can't do withdrawals because their earn product was financed through Genesis, another big crypto lender, and Genesis had lent a load of money to Alameda, which is now gone. So
and Genesis are now in trouble as well. And apparently, apparently they're the main lender to all of the exchanges. It's crazy.
So yeah, so it's pretty nuts. But and look, there's actually even more ways they're tied in. Like, for example, FTX bailed out a lot of this, particularly in the US. They're not too big over here, but like Voyager Digital, they were a big savings program. Like Celsius,
BlockFi,
they bailed out BlockFi.
Yeah,
and like the deal they did with BlockFi was just adding to the Ponzi scheme. It was basically like, no, so it's something along these lines. The exact figures are again hard to decipher because it hasn't all came out yet. But BlockFi were basically, FTX said they'd give BlockFi $500 million or 250 million, 500, can't remember which one, 250 million or $500 million line of credit to stop them from going under 3 or 4 months ago. But it seems that it was stipulated that all the funds had to be moved to FTX now for custody. So what BlockFi seemingly didn't know, maybe they did know, I don't know, but seems they didn't know, was that all those funds, FTX wanted this deal because they got all the user funds, which they were then just lending out to their hedge fund to make more money. And then, that's all gone now. So
BlockFi would have been better off just going into bankruptcy back at the time. There would have been more assets available than now.
Yeah, it's like, well, we can only speculate, but like BlockFi have lost, it seems, absolutely all their customers' money now, whereas before they were just short. They hadn't lost, like they lost. Yeah, they were short, and they were short a significant amount, but it wasn't something that was going to bury them. Like, they were still a valuable. Well, if they didn't get help, it would have buried them. But they're still a valuable company.
Yeah, but customers could have got 50 cents on the dollar or 70 cents on the dollar. Who knows? But now they're probably getting 0 cents on the dollar. So it was a disaster. And I know you're Bitcoin only, so none of this really affects Bitcoin companies who sort of try and distance themselves from this tokenomics and creating your own token and basically printing your own money and running your own Ponzi scheme, which a lot of people who be newer to the space, they don't understand the difference. They just think Bitcoin is at the top and then all the other tokens that come under it are just different types of Bitcoins. But it's probably a harsh lesson to a lot of people, that there is a really big difference between the sort of pristine collateral that Bitcoin is and the air tokens that anyone can spin up, and it can become the second most valuable crypto company in the world within 3-4 years and then implode within a handful of days. It's a harsh lesson.
Yeah.
But I suppose ultimately, here's my question to you. Is it a good thing that FTX blew up and is going to cause carnage? Or should the Ponzi scheme have continued longer and would have caused a bigger forest fire? Like, is it just a culling that's needed in the evolution of anything, where you have to get out the bad stuff, weed out the weeds?
Yeah, look, I definitely think, well, it's very sad what's happening. People are losing money. So the first thing, now, it's not financial advice, but in my opinion, is what a lot of people around me are doing, what I'm doing. Just take your Bitcoin off the exchange. Like, there is no benefit to having your Bitcoin sit on the exchange. You're not getting paid for it. You're just leaving yourself open to the likes of, now, a lot of them are reining in what, if they were doing that, they're reining it in big time now to try and cover themselves. But you don't know who's left short. So just take your Bitcoin off and don't dilly-dally with it. Just like, because it can be a bit of a problem. You might have to order a hardware wallet or whatever. First thing, just spin up a Bitcoin wallet online. Make sure you're not getting, like, you're downloading any hack software, and you go to somewhere credible like Exodus or somewhere like that, or preferably get a hardware wallet, buy it on Amazon, get like 1 day delivery, whatever, next day delivery, get it delivered, and then just take your Bitcoin off the exchange, because you're totally you're just safe. When you hold your own Bitcoin, you're grand. No one can touch that. So this whole thing doesn't affect Bitcoin at all, really itself. Bitcoin's still operating like what they say in Bitcoin is TikTok next block. It continues. Like when Mt. Gox, the largest Bitcoin exchange, collapsed.
Sorry, Jack, I just
Okay.
got a little blip there.
Okay, no problem. So when the largest Bitcoin exchange was basically the collapse 10 years ago, or 6, 7, 8 years ago, Mt. Gox, there was like hundreds of thousands of Bitcoin lost. Now, at the time, this was seen as absolutely catastrophic for the whole industry. And to be honest, it was, because Bitcoin was much smaller then. And like people didn't really understand the importance of self-custody and all this. So now, we're many years on now. This is probably as big as Mt. Gox, if not bigger, because you have all the other crypto stuff tied in. But I suppose the thing is, crypto and Bitcoin aren't really the same thing. Like Bitcoin is, amazing. Like everything you teach, you can even say it better than I can. Great store of value. The fundamentals are all solid for good, solid money. Great freedom money. Great implications for humanity going forward. Crypto is just riding on the tails of Bitcoin. Like it's not, most of these projects were just outright kind of VC backed Ponzi schemes that were there, didn't really have any fundamental value. No one had any real use for it. All kind of, backed by companies per se. Like it was just like a company issuing a stock out of thin air, and then they're saying it's like Bitcoin, but it's better, even though it's not really better. A lot of these narratives are false. They pump it up, and then they start engaging in all these kind of mad behaviors that when times are good, seem like it's a money printing machine, like what FTX were doing. So that has no bearing on Bitcoin itself. Once you take your keys off the exchange, when you take your Bitcoin off the exchange, self-custody your own keys, you're out of the whole thing. Now, like what you said about natural market clearing event, like this was always going to happen. Like me and you were talking, 7 or 8 months ago, when I first met you, and it didn't really seem that it would happen quite this fast, or in this. Well, I didn't think it would happen quite this fast in this way, and I don't think it was obvious just how much was totally dodgy about the space. But like Bitcoin went from, over the course of 5 or 6 years, a couple grand all the way up to 70 grand and back down. So there had to be a massive cleansing event. It's just the nature of markets, especially in like Bitcoin isn't unregulated, but because it can't be regulated, but the whole space itself is very like, it is a total free market at play here. So like, this was always going to happen. The same way you had in the .com crash of the early 2000s, you had all the mad stuff happening in the markets, and then there was a massive wipeout, and nearly every company involved went to zero, more or less. But you still had the king companies, like Amazon, that came out of it. And look at Amazon now, the biggest company in the world today. So look, I suppose the whole thing, you just got to go back to basics, take your money off the exchange. I think this is a good thing long term. It'll be spun as a bad thing, most likely by regulators, etc., who don't really understand that Bitcoin and crypto aren't the same thing. They're going to come at it with an angle to say that we need to regulate these companies like banks, and banks should mind your Bitcoin and all this stuff. But really, none of this would have happened if everyone just self-custodied their Bitcoin, because like the exchanges couldn't have done what they did. So I think it's a good thing. It's sad what happened. This will kind of make everyone really go back to the drawing board, really learn about Bitcoin. They need to take the time to understand what's really going on here, read the Bitcoin standard, read all the Bitcoin books, listen to people like yourself. And yeah, look, if it's too good to be true, it probably is true. So like if it probably is too good to be true. So like if you look at if you're getting 12% yield on some platform, like there's so much risk associated with that they're never going to tell you any of it. Just be happy with the fact that like if you think Bitcoin is the future and you understand it, you think it's going to take over the world, like in that case Bitcoin is probably going to go like 20 or 30x. That should be good enough for anyone. So why are you trying to risk it all for an extra 10% a year? Like it's just yeah, I think it's a lot clearer now, the risk reward at the end of all this.
Yeah, it's just the sort of short term. How I see it is, Sam Bankman-Fried is a short term thinker. He's a trader, and traders are losers because 90% of them lose their money. So here we go. Made a lot of money, but ultimately lost it all. This is why investors are winners. Investors are the billionaires of the world. They're investors. They invest into companies or they invest into great assets and held them for a really long period of time. It's so simple. But Jack, thanks for your time. I know you're busy there. I know you're working in the Bitcoin space. We're probably not ready to talk about that yet, so we won't on what you're building. But it's been awesome to have you on. It's been great to do a little shared broadcast and get your take on it. So thanks for coming on. And the guys can catch you on Twitter if anyone wants to follow you. What's your Twitter handle?
Yeah, it's Still Early Jack. So STILLEARLY and then Jack.
Still Early Jack.
As it says, we're still early.
We're still early. I wonder will that be still be working in 10 years, that Twitter handle? You'll be known as the OG.
Yeah, well, look, maybe, because it might take longer than 10 years. Who knows? Like, especially if stuff like this keeps happening.
Yeah, certainly. It's all about education, and it's all about just communicating the differences, and you can learn the hard way or the easy way, but ultimately everyone will, I think, and I think you think, will learn the difference between Bitcoin and crypto. Jack, thanks very much for coming on.
Not crypto, and take custody of your own keys. All right. Okay.
Not your keys, not your coins. Thanks, Jack. Bye-bye. Take care, man. Bye-bye.